Good morning and welcome to Chevron's Investor Day. As you saw in that video, Chevron has a storied past and an even more compelling future. I'm excited to show you we're bigger, stronger, and better than ever, and poised to deliver even stronger cash flow and growing value. I'll start with industry-leading free cash flow growth. It's here, now. We're delivering on every milestone we set out. And as you'll see today, we view this as just the beginning. We built a resilient, world-class portfolio with a premier upstream position in the industry. High margin, low break-even, and balanced across asset classes and regions. We have a highly competitive downstream and chemicals business. And we've developed diversified growth options that extend through this decade and into the next. Importantly, we remain committed to superior shareholder returns. Capital discipline is at our core, and it's what positions us to translate higher free cash flow into consistent returns for shareholders. In short, Chevron is stronger, more resilient, and better positioned than ever. And we're excited to show you why we believe the best is yet to come. The foundation for performance at Chevron starts with safety. Protecting people, assets, communities, and the environment is our highest priority. Producing the energy the world needs involves inherent risks. This year, we've experienced incidents that remind us how important it is that effective safeguards are always in place. We're focused on learning from these events and implementing actions that improve our ability to deliver energy safely and reliably. The world's appetite for energy continues to grow. Reliable and affordable energy remain essential for human progress. Oil and gas demand is at an all-time high. It will set another record this year, and it's expected to do so again next year, and again the year after that, and beyond. Due simply to field decline, there's a need for significant investment to close the oil supply gap, equivalent to 5 Saudi Arabias that would otherwise appear over just the next decade. Demand for gas is expected to grow even faster than for oil, including the critical role gas will play providing the energy backbone for data centers and advanced computing. Meeting this demand will require scale, expertise, technology, partnerships, and financial strength. This is where Chevron excels. For decades, our vision has been to be the global energy company most admired for its people, partnership, and performance. We've also consistently held a simple, clear objective: lower returns, higher returns, and lower carbon. We've been an industry leader on capital discipline. We believe that costs always matter. We've demonstrated a track record of dependably increasing cash returns to shareholders. Our approach to new energy has been pragmatic. We'll invest only where we believe we can compete and deliver returns. This isn't about chasing headlines. It's about creating value. And we're lowering the carbon intensity of our operations, cutting the carbon intensity of our oil production almost in half over less than a decade. Some things are changing at Chevron, including our organizational model and our portfolio. What hasn't changed is our approach to creating value. As I said earlier, Chevron is bigger, stronger, and better than ever. Over the last decade, we've reshaped the portfolio, grown production, become even more cost and capital efficient, and steadily grown cash returns to shareholders. Production is up by over 1 million barrels of oil equivalent per day, an increase of more than 40%. At the same time, that capital spending is down by nearly 40%. Unit development costs are lower, and capital efficiency is higher. Divestments and concession expirations have been more than offset by inorganic growth in the Eastern Mediterranean, DJ Basin, Guyana, and the Bakken, And we've delivered organic growth in Kazakhstan, Australia, Gulf of America, and the Permian. We've also built a leaner operating model, changing how and where we work, while keeping a relentless focus on efficiency. All that enables us to return over 3 times more cash to shareholders today versus a decade ago, while keeping our share count relatively flat. And we're building on that momentum to become even better. Over the last year, we've delivered on core milestones that result in industry-leading growth in cash flow, volume, and value. From 2024 to 2026, cash flow from operations is projected to grow at 3 times the rate of our nearest peer. That's underpinned by an expected production compound annual growth rate of 10%, more than 40% higher than the growth rate of our next best competitor. And we'll be even better positioned to withstand the volatility of commodity markets, with the break-even price to cover both CapEx and the dividend expected to be below $50 Brent. In over 43 years in this industry, I've seen more than a few cycles and surprises. You can count on us to be prepared for the unexpected and resilient through any headwinds. And the improvement doesn't just end in 2026. Over the next 5 years, we expect annual adjusted free cash flow growth to average greater than 10% at a nominal $70 Brent price. And at real prices, escalating over time like many of our peers use, that growth would average over 14% annually. This outlook is underpinned by our world-class upstream assets, where we continue to increase capital efficiency across our shale portfolio, optimize world-scale fields in Kazakhstan and Australia, and grow high-margin deep-water production. We had diversified growth through new chemicals projects and new power solutions. Never in my career have I seen a higher confidence outlook, further into the future, and with lower execution risk than I see today. Underlying it all is a relentless focus on lowering operating costs, using innovation and technology to expand margins, and remaining disciplined on capital. And this expected growth is even higher on a per-share basis. Assuming the midpoint of our buyback guide, this would add over $8 of adjusted free cash flow per share over the next 5 years, nearly doubling our expected 2025 rate. Chevron's purpose is to develop the affordable, reliable, ever cleaner energy that enables human progress today and well into the future. So before I hand it off to Eimear, let me just say a few words about the role of innovation and technology, including AI. Innovation has long been a core strength at Chevron, enabling us to work faster, smarter, and safer every day. This continues in all core areas of technical focus, and we continue to see higher levels of performance in our assets as a result. We expect artificial intelligence to enable the next leg in this journey, driving improvements in efficiency, asset productivity, optimization, and exploration outcomes. Both Mark and Jeff will share examples of what we're already doing with AI. We have a dedicated enterprise team focused on integrating AI into how we work every day, prioritizing the highest value opportunities across our business. We also believe Chevron has a meaningful role to play in meeting the growing power demand created by new data centers. Jeff is leading this effort and will share more in his comments. With that, I'll hand it over to Eimear to discuss our financial priorities.
Thanks, Mike. Good morning, everyone. Chevron's financial priorities are long-standing. Grow the dividend consistently, invest capital efficiently, maintain a strong balance sheet, and buy back shares steadily through the cycle. So let's start with the dividend. Simply put, we reward shareholders first. And our track record proves it. We have the highest average growth rate of our peers over the last 25 years, and you can see that our consistency is unmatched. We know our shareholders rely on our dividend. We don't cut it in times of pressure, and our capital discipline focus enables continued growth through commodity cycles. Our consistent approach to rewarding shareholders stands out from the competition. Our second priority is to invest capital efficiently. And over the last decade, we've led the industry in a more disciplined and efficient level of investment. Since 2021, our capital efficiency has been better than both the peer and S&P 500 averages. And we expect that leadership to continue. As Mike noted, we've reduced CapEx by 40% over the last decade. And today, we're reducing the annual CapEx guidance range by $1 billion to $18 to $21 billion through to 2030. This capital program supports our forecasted growth in earnings and cash flow and is balanced between short and long cycle projects across diversified asset classes and geographies. We believe capital discipline is fundamental to our strategy in providing long-term value for our shareholders. We also understand how important it is to our shareholders to manage volatility through commodity cycles. Our strong balance sheet is an asset that we use to mitigate risk and create value. Given strong cash generation, our debt coverage ratio is nearly twice as strong as the S&P 500 average at current prices. And even at $50 Brent, we expect it would remain better than the average. We have surplus debt capacity and hold a AA credit rating. This strong credit resulted in some of the tightest spreads across all of corporate America in our recent bond offering. With a portfolio that has the lowest upstream break-evens, a flexible investment program, and a premium balance sheet, we're positioned for any price environment. Now to our fourth and last financial priority, buying back shares steadily through the cycle. We've bought back shares in 18 of the last 22 years and established new records in each of the past 3, averaging a reduction of about 5% of shares annually. Given our stronger cash flow growth, we're reducing our price assumption for the top end of the range from $85 to $80 Brent. Over the period, we expect to repurchase $10 to $20 billion annually at average prices of $60 to $80 Brent. Our consistent approach underscores our priority of steadily returning cash to shareholders. We have a proven track record of maximizing value, consistently high-grading our portfolio by divesting assets that don't compete for capital and delivering synergies on the assets that we bring in. We announced a $10 to $15 billion divestment target by 2028, and we've already achieved $9 billion. Looking ahead, we expect $1 to $2 billion of asset sales per year through 2030. We've successfully integrated multiple quality companies that have bought great assets and great people and have created even more value than expected. The Hess integration is largely complete, and we've already delivered our initial $1 billion run rate synergy target. What was expected to take 12 months was achieved in just 3. With this momentum, we're raising our Hess synergy target to $1.5 billion by the end of 2026. Now, as you've heard us say many times before, costs always matter, and they always will. We're focused on running our assets as efficiently as possible. This includes continuous improvement across all levels of the company, where we relentlessly benchmark and pursue performance that's better than the best. Recent changes to our operating model and ongoing standardization across the company are already delivering results. And we're leaning in on technology, and AI to do our work safer, faster, and at a lower cost. With the great progress that we've made and the actions underway, we're raising our structural cost reduction target to $3 to $4 billion of annual run rate savings by the end of 2026. Delivering high return volume growth while also lowering our absolute costs is expected to deliver strong earnings growth through the end of the decade. And when you combine this with our buyback program, we expect to further expand returns on a per-share basis. In addition to the cash flow Mike talked about, at flat nominal $70 Brent, we expect annual average adjusted earnings per share growth of more than 10% through 2030. And at escalated real prices, it's over 14%. With this growth, along with continued capital discipline, we expect greater than 3% improvement in return on capital employed by 2030 at flat nominal $70 Brent. And at escalated real prices, this improvement would be almost double. Bringing it all together, we've got a winning combination. First, the free cash flow inflection is here. And as Mike said, we see this as just the beginning. We expect to generate more cash and keep growing through the end of the decade. Second, as I just showed you, we expect to increase earnings and returns. And finally, we remain focused on capital and cost discipline, lowering capital guidance, and increasing our structural cost reduction target. So I'll leave you with this. Chevron offers a unique proposition: a commitment to shareholder returns, a strong growth trajectory, and leading resiliency. No other company in the S&P 100 matches our combination of forecasted earnings and cash flow growth, balance sheet strength, and a market-leading dividend. At our historic dividend growth rate and the midpoint of our buyback guidance, we'd return over 45% of the current market cap to shareholders over the next 5 years. Thank you.